I'm Kyle Tetting, Director of Research at Landaas Company.
Kyle, when you hold a magnifying glass to an investment portfolio, one of the things that you zoom in on is the beta. Remind us again what that is.
Yeah, ultimately, beta is really our way to measure the risk of a portfolio or even of a particular investment, but our way of measuring that relative to a benchmark.
And why is that important?
We really believe in risk-first allocation here. Our first objective is to set an asset allocation for clients that really tailors a portfolio to a level of risk. And so our way of measuring that is beta, and that's why it's so important for us and why it's one of the first tools that we use to kind of get a sense of where a portfolio is.
So it's measuring risk because of the need for preservation of wealth.
Yeah, it really tells us, okay, relative to the benchmark, what can we expect this portfolio to do? And it's really a one-for-one trade. A beta of 1 relative to a benchmark tells us that we're going to be even with that benchmark. The market goes up 10% or our benchmark goes up 10, and a beta of 1, our portfolio should go also up 10. Beta of 0.5 would be 50% of the movement of the market.
So it's measuring the sensitivity of an investment to some given benchmark.
That's absolutely right.
Kyle, what sorts of shortcomings should investors know about?
I think the biggest issue with beta is that you can really use it to describe anything you want. So while that's a great tool, it can also provide some pretty big challenges in that it isn't as easy as just saying this is your relationship between your portfolio and an underlying benchmark. You really want to make sure that those two are related in some way.
So it's trying to measure apples against apples.
Yes, you want to make sure you're measuring apples against apples, and that's when beta really becomes useful. And you can really start to measure what the actual risk is relative to the benchmark.
And we have the R squared to help us determine
We've got
whether
that
the beta
coefficient
is
of determination there. It really tells us how well the data fits that relationship. And so the higher the R square, up to 100, the more accurate that data is going to be, the more accurate that fit is going to be between the two things that you're measuring. The lower it is, the worse the fit.
And it's also historically based, so that's not necessarily predicting what's going to happen.
Yeah, that's absolutely correct. And that's a really important point. It doesn't tell you what will happen for your portfolio or for the market. Many things can change the relationship between two different portfolios or a portfolio and an index. But it does tell you over time this has been the relationship.
So just to sum up, what is the most important thing that investors should know about beta?
I think for investors, the most important thing about beta is that it really gives them an idea of how volatile their portfolio should be relative to a benchmark. It's easy for us to say the S&P 500 because that's what they're going to see on the news. Here's what you can expect your portfolio to do relative to that benchmark.